This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And you're listening to episode 95. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the microcap message. For this episode of the Planet MicroCap Podcast, I spoke with Meb Faber, host of the Meb Faber Podcast and co-founder and the chief investment officer of Cambria Investment Management. Some of you may be familiar with Meb's very popular podcast, the Meb Faber Podcast. I'm also a big fan of Meb and thought it would be fun to invite him on the podcast to learn even more from him. In this interview, we cover a multitude of topics, including his books that he's written over the years, his investing strategy, trend following, and much more. Thank you again for tuning in to episode 95, and please enjoy my interview with Meb Faber. But first, a word from our sponsor. Hi everyone, Robert Kraft here, your host on the Planet MicroCap Podcast. As some of you may know, when I'm not interviewing folks for the podcast, I also host CEO video interviews and Wall Street Views with investing experts for SNN's YouTube channel, SNN Network. I wanted to take a moment to invite you all to subscribe to the SNN Network YouTube channel. As a subscriber, you'll be the first to be notified when we publish a new CEO video interview with microcap management teams, a new Wall Street View video interview with investing experts, panels and keynote presentations from our conferences, as well as new and archived podcast interviews. Go to www.youtube.com/SNNWire and click the subscribe button. Again, that's www.youtube.com/SNNWire and click subscribe. Thank you for subscribing and for your continued support. For this episode of the Planet MicroCap Podcast, I would like to welcome Meb Faber, host of the Meb Faber Podcast and the co-founder and the chief investment officer of Cambria Investment Management. Meb, welcome to the Planet MicroCap Podcast.
Great to be here. Thanks for having me.
It's great to have you on, man. Thank you for taking the time out to do this.
Yeah, no sweat.
Cool. So let's start with your background. You know, how'd you get your start in the world of finance and investing?
How far you want to go back? You want to go back to childhood? You want to go back to college?
I was actually thinking as soon as your father caught you out of the womb, if possible.
You know, cool? It's an interesting analogy because, you know, I did have that relationship with both my parents where we talked about personal finance and investing. You know, they came from very different backgrounds. My father grew up, you know, dirt poor on a farm, no running water, sort of outhouse, which sounds crazy to think about, but, you know, was kind of a self-made man. And my mother was always interested in investing. Her father had worked for one of history's greatest performing stocks. And so they kind of came at it from two different perspectives and two very different perspectives, but you know, we grew up in a normal middle-class family in Colorado and a little bit in North Carolina. Anyway, but I did have those discussions, not quite in the womb, but that was certainly for like many people, the way that you started to learn about the world of finance and investing. And in some of those lessons, in retrospect, you know, as a professional now, we're probably not the best way to be taught about investing. Anyway, you know, I followed the footsteps of most of the males in my family. Was an engineer in university, studied actually biotech engineering, started out as a biotech equity analyst while taking a year off before going back to grad school. That was the plan. Ended up taking grad school at night anyway. Was in Gaithersburg, Maryland, so I was taking grad school at Hopkins while working for a biotech mutual fund. So kind of marrying my two interests of both biotech and investing. And this would have been in the this would have been in the fall of 2000. So pretty interesting timing to be starting a investment job.
A little bit.
As not only did you have the investing bubble, market cap, sort of tech.com bubble bursting, but also the biotech. That was a lot of news flow going on then with the human genome sequencing and everything else. Anyway, so I kind of got it from both sides. But long-winded answer to saying kind of that 1 year sojourn of working before going back to grad school became two became three, and it's been a bit of a divergence where my career became my hobby and vice versa. But yeah, I think the seeds were certainly sown. We have I found an old postcard years after my father passed that I'd written to him from some camp where I was talking about stock ideas, which sounds kind of crazy. And then we actually looked up the returns of those stocks many years later. And I think my entire career would have been better just by buying those and going away and never never doing anything else in my career. But that's the short history.
Well, thankful for us you didn't do that, but I'm also equally very sorry for you in that sense. I mean, look, I think
it was Anheuser-Busch. What was the other one? Disney was the big one, I think, and another one that got acquired. I'll have to look it up, see if I can find them for you.
Nice. And so when you went to school to get your degree in biotech engineering, by the way, you're actually not the first person I've interviewed who went to school for biotech engineering and then never spent a day in a lab afterwards. Actually went right to doing equity analysis. I mean, did you always kind of know, like, all right, I'm getting this degree. This is what interests me. I need to specialize in something so that I can get a better analyst job? I mean, what was the thought process?
No, I was fully planning on being on the biotech side. I think it had its own way of fate selecting me out because I was always terrible at the lab. I'd always joke I'd spill viruses everywhere. I'd come in, despite being a quant now, my attention to detail in a lab was probably not what it should be. So I don't think I had a choice. I think I was spit out the other side with no choice in the matter.
Mm-hmm. So then what led you to starting Cambria Investment Management? It sounds like there's some gap years there between working as an analyst at another firm and then starting up your own shop.
Yeah, I'd worked in San Francisco and Lake Tahoe as a quant for a startup commodity trading advisor. Didn't really go anywhere. I like to say more that I was a ski bum than anything, and then had moved down to Los Angeles to start the company with my partner. This would have been 2006. We started Managed Money in 2007. Really had no idea what we wanted to be when we grew up. Knew we had some ideas on investing. He had come from a venture capital, corporate, legal, sort of transactional background. Had done a lot of financing for companies, but more what you would view as a traditional VC or banking side, not investment advisor. And I'd come from the research side, never having worked building an investment advisor or hedge fund or whatnot. So we didn't really know. And we started out with some private funds and separate accounts and kind of grew from there.
Mm-hmm. So what came first? And we'll get more in depth on your white paper a little bit later in the interview. But what came first? The white paper that you wrote, titled "A Quantitative Approach to Tactical Asset Allocation," or the fund? Did the fund allow you the time to write this up, or what was the time frame there?
We had completed a bunch of the research internally and had no intention of ever publishing or writing anything ever. And the way fate again would have it was that I was trying to avoid taking a level 3 test. This was for the CMT, kind of the technical version of the CFA, or redheaded stepchild cousin, I guess. And so I really didn't want to take the test because I thought a lot of the material was garbage. And so they used to have a requirement you could write a paper, but they announced that they were doing away with that requirement. Mm-hmm. So the last thing I wanted to do was take the test and memorize a bunch of stuff I thought was a bit like sorcery. And so I turned in an abstract at the last minute and then said, if I'm going to write this paper, I may as well submit it to some journals, go to all this effort of putting this together. I may as well publish it. Mm-hmm. And so we ended up getting it published in the journal Wealth Management. And I'm not sure exactly which had come first as far as the publication versus the funds launching, but the research had been done in-house for some time already. Mm-hmm. And so that was kind of long done, but the actual putting pen to paper was oddly enough just to avoid taking a test.
By the way, how old were you at the time when you started the fund?
Would have been late 20s, somewhere in there.
That's awesome. That's so cool. I mean, were you scared at all? I mean, late 20s, starting up your own shop, you got to go out and raise funds. I mean, that must have been a little frightening.
I mean, too dumb to be scared, really. I remember when I joined Eric to take the job, I said I'd actually turned down a much better job, much higher paying job in Bay Area. Mm-hmm. And my entire family thought I was very foolish. But I said, look, what's the downside is I lived at the beach for a year or two. I'd never been to the beach, really lived. I actually thought LA was a fairly terrible place before moving there. Now I love it. But it said, worst case scenario is, I work for a year or two, it doesn't go anywhere, and I go on to do something else. So didn't really feel that sort of, responsibility. Didn't have a partner, didn't have any children, didn't have any pets, not a whole lot of things I needed to answer to other than just myself.
Mm-hmm. So then my next question is because on the Cambria website, you describe the firm as quants, quote unquote. Before we get into the process itself, did you bring in that strategy, or did you, when you partnered up with Eric, were you like, all right, let's kind of do a combo of what I know best, what you know best, and that'll be it? How did you decide on what the firm strategy was going to be?
It's like many things evolves over time, but the genesis of the firm and the paper and everything else was a trend following type strategy. And, trend following, and I'd say the other pillar that we use for most of our strategies is, of course, value. And these are strategies that have been around for 100 years. So it's not like something we've invented or is massively proprietary. Certainly we put our own spin and story around it, but a lot of the strategies that we've implemented have been around for certainly decades, if not over 100 years. And so, we manage over 11 funds now, soon to be another one next week. But the whole origin was trend following, which had been developed over the years. I mean, the reason I became a quant was the discretionary subjective side of the business is, of course, very hard, but also you learn quickly. I have and still have, all the behavioral biases. And so I made all the mistakes, certainly in my 20s, that people would make, being overconfident and trading too much and taking on too much risk. I could tell about 20 more, but that's what eventually pushed me to my style, which is wanting to be rules-based. And, everyone's got their own style. It's not the way Buffett does it, and it's not the way that Stevie Cohen does it or anyone else. But, that's the kind of the whole point, is eventually you find something that works for you. And if we know anything about investing, is there's a million ways to make money and plenty that are just fine. But most important, finding the one that really resonates.
Dude, listen, if there was only one way to invest and make money, I think I'd only have one episode of my podcast, and I only think you'd have one too. So I'm very thankful for that. So let's get into your trend following strategy. Tell us a little bit more about your investing thesis and how it works.
So, the concept of the original paper, and we just wrote a 10-year retrospective for the Journal of Wealth Management. This was, before the financial crisis. And so, trend following has been around forever, certainly since the time of Charles Dow, but really implemented since the 70s and 80s by the famous Turtles and commodity trading advisors and a gazillion other people. And, the common understanding of trend following, I thought, was not well described or accurate. And so a lot of people just immediately put the label of market timing on top of this strategy. And that's accurate, but in my opinion, everything is active. Whether you do market cap weighted indexing or something else, every decision in investing is an active decision. And so, we said, look, here's a very simple rule. It's not optimized. We'll apply it to every asset class that we track. Here's how it's done historically. And the main takeaway was that it wasn't that it was a magical, I'm going to sell at the top and buy at the bottom and double my returns and move to the Caribbean and drink pina coladas. It was more of a risk reduction, volatility reducing kind of strategy that would hopefully keep you out of the really big bad bear markets. So not the 0 to 20, but really the 40, 60, 80 plus bear markets. And that's historically what the simulation showed. Now, of course, the reason the paper became so popular was the financial crisis happened within a year or two after publication. So it looked brilliant. Of course, if I had published it in 2009 or 10, nobody would have read it because they would have said, that's obvious, you idiot, you're using hindsight bias. But I was very honest about that in the retrospective, said, look, that there's, for as brilliant as people would probably say we looked in 08 or 09, a strategy like trend following probably has looked the opposite in the years since. And almost every investing strategy has its own challenges. And trend following, the big one, is looking different. And typically when markets are going sideways or doing reversals, this concept of using the trend may or may not be useful.
Mm-hmm. So you say that you currently are managing over 11 funds, another one coming out next week. So do you have different data points for each one of these funds? And if so, what are some of those data points that you look for so that signals? And I also, I guess, to clear this up too, is the fund itself a basket of individual companies, or is it an ETF? How do you actually then deploy it into some of these different asset classes?
So let me talk about, there's about 4 criteria that we think are really important before we launch a fund. And the first being is it has to be something that doesn't exist, or we think we can do a lot better or a lot cheaper. Because otherwise, if we're just going to do another fund that's just going to clone Vanguard or iShares or someone else, what's the point? There's well over 10,000 public funds through mutual funds and ETFs. Do we really need any more? And so we're only launching funds that we think don't exist, or we think that, again, we can do much better or cheaper. Cheaper is getting more and more rare these days. I think the race to zero and expense ratio is a fantastic development for the end investor, but there's still some cases where that's happening. And so that's the first criteria. Second is that there has to be some fair amount of academic and or practitioner research that supports the concept. A lot of these ideas that come out, it's just the issuers trying to throw spaghetti against the wall and see what sticks. They'll launch 100 funds with the hopes that a few of them get really big, and the actual strategy can be totally nonsensical, and they're okay with that because it's like a venture capital model. I don't really want to do that sort of business. I don't think it's, as a fiduciary, the right thing to do. Third, it has to be something that I want to invest in. I want to put my own money into, and it's a surprise to people, but the vast majority of mutual fund managers have $0 invested in their own fund, which is a really strange takeaway. You think, why would this portfolio manager be selling me or trying to convince me on TV to buy his fund when he actually doesn't invest in it? And that's just the sad reality that a lot of these people just don't have any skin in the game. And I invest all my public assets in our funds exclusively, so 100%. But that's, to me, the whole point. Why would we launch something unless I wanted to put some money into it? And then lastly, of course, it has to be something that people actually want. So there's strategies that we've developed that I think are brilliant, but I don't think anyone on the planet would actually invest in them. So it has to be a bit of a viable business too. Otherwise, you're just entertaining yourself. So that's kind of gives you a pretty broad framework for how to think about putting funds out there. That having been said, the lineup then goes from everything to super broad asset allocation funds all the way down to extremely niche funds focusing on one demographic or target idea, and then everything in between. So some are more like Legos that help you build part of the overall portfolio, and some theoretically could be one fund your entire portfolio. It's a bit of choose your own adventure on which one works for the end investor. And I think as of last month, there's over 35,000 investors across all the funds. So you got all types represented.
Nice. And I have to ask, I mean, this is a microcap podcast. I mean, do you have a fund specifically for small, micro, nano-cap stocks?
Some of ours tilt small or mid cap. They tend to be size agnostic, meaning if they're finding opportunity in the small cap arena, they could be 100% small cap. So we have a shareholder yield suite that focuses on value stocks that are companies that are distributing cash flows through buybacks and dividends. And those tend to be high quality companies that are cheap. In the U.S., that skews larger, mid cap to larger. Abroad, it skews quite a bit smaller. Doesn't get into the micro cap. One of the challenges with being a fund manager is, it's particularly in the ETF space, is you need to have capacity. And we certainly don't have this problem, but theoretically, if the funds started to get to 10 or 50 billion, then microcaps are a little harder. But I'm open to ideas. That might be something we'd be interested in the future.
Gotcha. So I have to ask, I mean, why did you make the choice to really focus on this quant strategy? Then, I've had a number of fund managers on here, asset managers that are, more on the qualitative side, maybe more concentrated portfolios, individual stocks. Why did you decide to go that route versus that?
Sorry. So, which route between
being a quant and more on the qualitative side?
I think it's two sides of the same coin. I mean, if you were to ask Buffett, you would clearly characterize him as a qualitative discretionary investor. But I guarantee you that you could probably write down his rules and come up with a pretty darn similar framework. And actually, AQR has done that. They published a paper called Buffett's Alpha, where they just decomposed him into a formula, and it does a fantastic job of picking value quality stocks. The big key there, in my opinion, is that his approach isn't actually that proprietary or complicated. His alpha is really, he sticks to it through thick and thin. So for me, it's just a lot easier. I think discretionary investing, there's certainly value to be had. I think you can do a lot of value add, and certainly the smaller or weirder or unfollowed areas of the world you go, the more possibility there is to really add serious value. Charlie Munger said this. Somebody asked him for advice recently, and he's like, you should go where the fish are. If you're fishing in the large cap pools, what are you, the 75th analyst that's going to have a interesting take on Apple, or are you looking into Nigerian small caps and have some real insight there that is useful and different? So for me, the discretionary stuff, it's possible and it's fun, but it's hella hard work. And I prefer the rules based. For some of the reasons I mentioned earlier is that I have a lot of the behavioral issues that muck people up in their investing process, and I think it's a lot easier and simpler for me to put it into a automated framework or construct that allows me to let the computer do all the heavy lifting.
Mm-hmm. That's pretty interesting, because I feel very similar in that sense, where especially if I'm, you're looking at a micro cap or small cap, maybe you have 4 or 5 stocks in your portfolio and you know so much, but I've also been very susceptible to almost every bias, so what's interesting is that you went this route because you really noticed that you were always susceptible to these things coming up whenever you saw new news or good, bad, indifferent, I mean, that sounds like it was really the case.
Yeah, I mean, and the best thing you can do as a young person is lose all your money doing the dumb stuff while you don't while you don't have much. It becomes life changing if you don't learn those lessons and do them when you're older and have a lot of responsibilities. But different people learn different lessons, and it's really hard to try to convey a lot of these lessons without going through it. I mean, the very real pain of losing money, if you haven't been through it, and you sit down with a millennial and write down on paper, say, look, this is what stocks have done historically. At some point, you'll probably lose a third. If you're 100% invested in stocks, once every decade or 2 or 3, you may lose 50%. But your big worst case is you'll actually lose, in the Great Depression, you lose 80%. And people can kind of grasp that. But then, once you look at your bank account or look at your portfolio and then you lose your job and, hey, you have these car payments and house payments and you have this vacation coming up and your spouse is in your ear about, hey, we should join this private school, all these life, events that start creeping in, and that portfolio goes from, a certain number, I don't know, let's call it $1 million if you're blessed and one of the wealthy people in the world, down to 800,000, down to 600,000, down to 400,000. That is something that people can logically or rationally try to respond to on paper ahead of time, but then once you go through it, it's a very real, physical, visceral reaction. And so some of these things, it's hard to convey without experiencing it. So our advice is always to make the dumb mistakes when you're really young.
For sure. I mean, that was part of the reason I started this podcast too, is that, my thesis has always been microcaps and have always been a nice place where you can, really learn the trade a little bit. And if you do lose, hopefully you're not investing too much, and you kind of pay your college tuition that way, or your trading tuition. So my next question then is, really between your books, white papers, and podcasts, your insights are really not only thought-provoking and interesting, but there's so much out there. And with that said, we could probably spend one podcast on each bit of from each book, each white paper, but we'll try and condense it here. And I wanted to start off with your first book, Global Asset Allocation. What was your thesis with this book?
So this is a fun book, and it's free if you guys go to CambriaInvestments.com, or you can add a link in the show notes. It's free to download, mainly because I have a large rivalry with Amazon currently. So I just made the books free, so you can get a pack of all three of our self-published books, 3 or 4, I can't remember.
Gonna have to ask about that after, actually.
Yeah. So anyway, so we had this thesis where you have all these people on TV, all these famous investors, gurus, people that are legit. I mean, that manage hundreds of billions of dollars. It's some of the most respected institutions in the world have at some point espoused publicly through an interview, a white paper, a book, a suggested asset allocation for investors. And so everyone from Rob Arnott at Research Affiliates to Dave Swinson, who runs the Yale Endowment, to Mohammed El-Arian, who runs he just joined a new endowment, I think, in the UK. I can't remember. Anyway, I used to run Harvard and PIMCO with Bill Gross. All these guys at some point, I say guys because they're mostly guys, have stated publicly, here's a recommended allocation. And these allocations are hugely different. So there's some people that say you need to put 25% in gold. Some say 0. Some say 90% in stocks. Some say only a quarter. So these massively different allocations. And I said, let's do a study where we look at these allocations and how they've done historically over time, and kind of tease out what we can learn about these totally different, what we call lazy portfolios. They're buy and hold. You rebalance them once a year or whenever, but pretty basic allocations. And there were some pretty profound takeaways, and I don't know really anyone else that agrees with me on the takeaways, so take this as you may. The first being is that you live in a world of infinite choice. So it's not just the 3 main categories were stocks, bonds, and real assets, but you can decompose that into emerging market stocks or treasury bonds and corporate bonds or REITs and commodities and everything in between. So we included I think it was about 13 asset classes in the book, and took it back to 1972. I think in the new update, we'll take it back to the 1920s. But we demonstrated that a couple things. One, every asset class did a great job of preserving and increasing wealth over the ensuing, 50 years, 40 years maybe when we published the book. They all moved up and to the right, so you got paid to own them, which is great. and they kind of zigged and zagged. The 1970s were a really tough time for investors because of the high inflation. But in general, they all did a pretty good job. Some were less volatile, some were more volatile. But at the end of the day, they all did well. The big surprising takeaway from the book was that of all the portfolios in the book, and I think if you include the appendix, there's probably 20. They clustered, if you exclude the permanent portfolio, and that's an old Harry Brown portfolio that has about half in cash and bonds, all of these strategies clustered within 1 percentage point return of each other over the entire period. So all this work, all this effort that people put into asset allocation, and all the time that everyone spends, how much I have in stocks, what's the Fed doing, what about gold, it's breaking out, how is inflation going to affect real estate, is the Fed interest rates coming down, what should I do with my bonds, what about negative yielding, what about Trump, what about Zika, all these things, right, that all day, what about employment, that goes on with the Wall Street Journal, CNBC, really didn't have an impact over the asset allocation over the entire period. And one of the reasons that it seems like they would have a hugely different return, despite only being 1 percentage point over the full period, was that the average between the best and the worst in any given year was 18 percentage points. So in the short term, you have this massive just noise of these things bouncing all around. But over the long term, they have a way of balancing out. And so then we then extended this a step further just to impress upon what we thought was the big takeaway here. And we said, all right, you go back to 1970, I'll give you a crystal ball. I'll say, I will let you invest in the single best asset allocation in this book. And that's a pretty monster time machine. The Vanguard or Barclays would probably pay $100 billion for that opportunity to see what's the best asset allocation. And the answer was, it was Muhammad Al-Aryan portfolio, which is not surprising because that's a very endowment style, heavy in equities portfolio. And stocks did exceptionally well throughout the 80s and 90s bull market, and at times, other times since. And I said, however, my caveat is you need to implement this portfolio with the average mutual fund of today, 2019, at 1.25%. Excuse me. Not the average cost in the 1970s. Index funds didn't really exist in the early part of the decade. And forget about how much the average funds cost and implementation and commissions and everything else. And just by implementing with the average mutual fund, you would take the performance of the best performing portfolio and make it almost as bad as the worst, which was permanent portfolio. And even then, that's not quite fair because permanent was the only one of the few portfolios that had consistent real returns in every decade. So it was just lower volatility. But the point being is that you convert the best performing allocation to almost as bad as the worst just by implementing it through normal fees of a mutual fund today. Now, if you then say, I don't trust myself, I need a financial advisor, I buy at the top, I sell at the bottom over and over again, average financial advisor of today is 1% per year. Well, that takes your return of the best performing asset allocation and makes it far worse than the worst. So if you think about that for a second, we live in a period today that's awesome. There's never been a better time in history to be an investor. Any investor out there right now who wants to invest in a global portfolio of ETFs can build any of these portfolios for essentially free. I think the total cost is 0.05%, 0.05 of 1%. And if you include short lending on that portfolio, which is something that not a lot of people understand well, but it's something that would then actually take the expense ratio of that fund and make it actually negative. So you're getting paid to own this portfolio. That's a far cry from the 90s, 80s, 70s expenses. So it's essentially investing is free. Well, in a world where investing is free for buy and hold asset allocation, why would anyone pay more? And that's a great question. They shouldn't. And on top of that, if you have an account at Vanguard or Robinhood, you can trade all those ETFs for free on commissions as well. And on top of that, ETFs are fairly tax efficient, so you're not going to be paying any taxes on them, except for the dividends and income. You can't get around that.
Right.
Unless you're in retirement. So anyway, this is a very long-winded answer of saying...
Hey, there was a lot of substance to this book. Please, I'm not stopping.
Yeah, and you guys can read it in like 20 minutes. And so it's an interesting takeaway, but we've been recently giving some talks to CFA societies around the country, and the Charter of Financial Analysts. These are the people that go through a very miserable 3-year process that's very rigorous and hard to become a financial analyst. And I said, look, the old hairs, the gray hairs in the room. This isn't going to matter as much as it is to the young people. Young people in the room, you have to prepare yourself in a world where buy and hold asset allocation is free. And I say that means it's a commodity. The definition of a commodity is something that is interchangeable, that there's really no value to be producing it. And I say you can go right now and invest in some of these funds and some of these robo-advisors for essentially no cost. And so imagine, what does that mean in a world where that's reality? And we have a fund that is a very low-cost asset allocation fund. And the thing is that the vast majority of asset allocation low-cost funds in the ETFs, it's like $5 billion. But the high-cost buy and hold mutual funds, which are less tax efficient, they're still well over $1 trillion. So, the media is all over this topic of, hey, a lot of flows are going in ETFs from mutual funds and yada, yada. Well, my argument is that it's not even in the early innings. It's not even batting practice yet. And people, once they realize, and the caveat of this is buy and hold strategic. Like, this isn't, people that are trying to add value. This is by definition, they're not doing anything. I think the world is ill prepared for that, with the industry of the 150 plus industries in the U.S. The one with, if not one of the highest profit margins is asset management. And you ring up old Jeff Bezos, who will say, your profit margin is my opportunity. This is something that I think the asset management industry is very poorly prepared for.
So let's say you had to write a volume 2 for this book. What would that be?
First would be, I'll take it back to the 1920s, just so for some longer perspective. And obviously, a lot of the asset classes didn't exist that long, so you'd have to simulate some of them. But I think that's instructive. 2 is that, I think the next extension is, okay, well, are there then other strategies or tactical or tilts or other things I can do to improve upon that? And I think there is. I think there's actually really easy things to do to improve upon these market cap weighted global portfolios. Because if you were to go out, the base case is the global market portfolio. If you went out and just bought the world, and that's one of the portfolios in the book, you bought every public security in the world, stocks and bonds and everything else, you end up with a portfolio that's about half stocks and bonds. And of that, it's about half U.S. and half foreign. And so, is there ways to improve upon that? And I think absolutely. So, the professionals that listen to me give the spiel are usually kind of depressed after the first part. What am I doing showing up to work every day? And I say, well, look, that's just the base case. That's the asset allocation for dummies.
Why did I spend the 3 years getting my CFA? Like, damn it.
Yeah, or entire careers, And so I said, well, it's the good news is I actually think it's fairly simple to improve upon that base case portfolio.
Gotcha. All right, so I'm going to do a quick transition to book 2, because I have a feeling that if we kept talking about book 1, we're going to be here all day. Which isn't the worst thing in the world, but I think we eventually need to eat. But in the other book I wanted to talk about, Global Value, you discuss how to spot bubbles, avoid market crashes, and earn big returns in the stock, or how to spot bubbles, avoid market crashes, and earn big returns in the stock market. So then, is it really possible for investors to identify emerging bubbles and then profit from their inflation?
Yeah. So let's take the time machine back to the 70s, where we were again with McFly and Biff and everyone else, and there was a neutron bomb that went off in the 1970s in the asset management world, and most people think it was the invention of the index. And what people usually mean when they say passive or index, John Bogle and Wells Fargo and others, when they developed it, it meant what's called market cap weighting. And market cap weighting is simply you invest in, let's say, the U.S. stock market, you invest the most in the biggest stocks all the way down to invest the least in the smallest ones. And so, the biggest today would be you have a few trillion-dollar companies or thereabouts, Microsoft, Amazon, Apple. And what surprises most people, even professionals in this world, is you ask people, you say, well, how does that actually weight them? And people say it's the biggest companies. And you say, yes, biggest by what measures? And they say, well, sales or earnings or revenue. And no, none of those are true. It's simply the price of the stock times shares outstanding, which does give you the market. But if you're an alien or someone looking at it as an investing strategy, is a really nonsensical investing strategy. It doesn't make any sense to just invest in no other part of anyone's life. Would you invest most money in just the things that are the biggest? And so as a strategy, it's fine. I mean, it's a naive trend following strategy, and you're guaranteed to own the winners. You're also guaranteed to own the losers. And over time, that's capitalism, and it gives you a pretty good return stream. But as an optimal one, it doesn't make a whole lot of sense. And the main reason it doesn't make sense is because there's no tether to fundamentals or value whatsoever. So as a stock price increases, it gets a bigger and bigger weight. Well, usually when a stock price is increasing, also means it's probably getting more and more expensive. And that actually turns out to be the case. There's a great Ned Davis study, and Research Affiliates has replicated this too, where if you simply invest in the largest stock in the stock market when it was the largest, you actually is a horrible investing strategy. So this over time would have been famous GE and Cisco and Apple. You underperform the market by about 3 percentage points per year. That extrapolates to every sector, that extrapolates to every country. And if you think about it, very simple investing strategy, just avoid the largest stock in every stock market. But, a reason why that makes sense is simply capitalism, where, by the time you get to be a $1 trillion company, pretty darn well be sure that some other young 20-something in Brazil or Italy or Australia would love to build a $1 trillion company too. So you have this creative destruction, and these big companies have bullseyes on their backs. And if you look at historically per decade, you don't see the same names really keeping those ranks. Standard Oil doesn't exist anymore, et cetera. So what we say is that if you're more thoughtful about building an investing strategy, almost any investing strategy will outperform market cap weighting. You could do equal weighting. You could do weighting stocks by letter of the alphabet. You could do whether you're wearing the CEO wears shorts, a dress, or pants, because all those break the market cap weighted link. And so our favorite, because it just makes the most sense to me, would be to use value. And I don't even think it even matters what sort of value you use. So in the book, we demonstrated this with countries that our favorite long-term value metric is 10-year price to earnings ratio, which gives you a long-term perspective. And historically for countries, that's around 17. But in the U.S. has been as low as 5, and it's been as high as 45 in the internet bubble when I was graduating college in December 1999. And it's pretty predictive of what happens in the future over the next 10 years. Not the next quarter, but the next 10 years, the returns are fairly predictive from the starting point of valuation. And it also applies to foreign countries. And you see even bigger examples of booms and busts in foreign countries. The biggest granddaddy of them all for us was Japan in the late 1980s. For the older people listening to this, hit a P ratio of almost 100. It was the biggest stock market in the world at that time, and it's still one of the biggest economies in the world. I think it's number 3 right now. And so the problem with market cap weighting on a country level is if you went back and market cap weighted this portfolio, you would have put most of your money in Japan in the 1980s when it was the most expensive country bubble we've ever seen in our lifetime. Does that make any sense? Like, that doesn't even check a common sense box, like why anyone would ever do that. And so not surprisingly, if you weight countries by equal weight or GDP weight or our favorite value weight, so you just buy the cheapest ones and avoid the most expensive, you outperform in some quite substantially over time. And part of that is because you're investing in the cheapest. Part of it is also because you're avoiding the most expensive, which is really dumb stuff. In the mid-2000s, everyone was marketing India and China and the BRICS, and everyone was excited about those countries, but they got into the P ratios in the 40s and 60s. and no wonder they had terrible returns since. And one of the problems with a strategy like this is you end up looking quite different. So right now, that means you'd be investing in countries like Russia or Brazil or Greece or half of Europe. And for a lot of people, that presents a career risk or a look too different risk that is really hard. And this year, it's not too much of a risk because I think Greece is up like 40% and Russia's up 30%. But rewind 4 or 5 years ago, and I guarantee you the listeners would have a very different response to me saying those names. Long-winded answer to saying is that, the point of this book is that if you don't have a fundamental anchor, or you don't have some sort of guidepost or instrument to give you perspective, then you're just flying blind. And you wouldn't know that buying a country at 50 PE ratio is a horrible idea because you wouldn't be looking for it. And the good news is, right, most of the world right now is fairly reasonably priced. So foreign stocks are around PE around 20, 21, 22. Emerging markets are down around 15. The cheapest bucket's down around 12. The bad news is the U.S. is up around 31. And again, it's not a bubble. It's not terrible. It just means it's probably going to have muted returns. But again, going back to the market cap discussion, you're also putting half in the U.S. if you're a market cap weighted investor. If you're someone who's American listening to this, you actually put 80% in the United States. And that's called a home country bias. And it's a really, really dumb thing to do. But it's a situation that happens over and over again everywhere around the world. So I think that the sensible way, again, about having a plan and having an automated process is that it'll keep you from investing in the really expensive stuff and keep you hopefully allocated more towards the stuff that's a little cheaper.
Mm-hmm. Well, it gives you I guess really, like you said, it gives you a place where you have something that you can latch on to. You have your set of rules and processes in place. You're not just saying, oh my gosh, look at all this news and information that's going on over here. I need to just go blindly take a position or take some action over here. All right, my numbers are telling me this, I'm going to go do this. Yeah. Right. So now I wanted to then now get into some of your white papers on the website, and the one that stood out to me was the investment pyramid. How would you say that this has changed over the years?
Well, it's funny because so much of what I talk about on Twitter, white papers, podcasts, books is to me like the final 10% or the final 5%. It matters and it's absolutely worth doing, but there are what we consider to be major muscle movements that are vastly more important that you have to have as a foundation. And so the example we used in this paper, younger people won't remember this, but the older ones will, is that there used to be a USDA food recommendation pyramid that guidelines they put out for Americans and how many calories they should eat and what should constitute most of it. And like the number one thing they suggested people eat was like bread and pasta and cereal, which today, I wouldn't say it's universally accepted, but it's fairly well accepted that, getting majority of your calories from sugar and carbs is probably not an ideal diet. So this is a very complicated topic that people go crazy about, but the formula is actually fairly simple. It's calories in versus calorie burned, and you can get much more technical about it, but that's really the main formula. And I guarantee you, if you only consume 500 calories a day and go run 10 miles, you're probably going to lose a lot of weight, and vice versa. If you consume 10,000 calories a day and watch reruns of The Simpsons, you're probably going to gain weight. But this concept was that, science, they say, advances one funeral at a time, and same thing with investing, where the beliefs of the 70s or 80s, they evolve and you learn things. And hey, my parents both used to smoke, and no one smokes anymore almost. They vape maybe, but don't smoke cigarettes because you learn that was probably a really dumb thing to do. So the same thing with investing is as the evidence piles up, as you learn things, it's the same sort of concept where, hey, maybe the way that we may have been doing it is not the right way, or maybe there's better ways to do it. I think the internet is a great disinfectant on, shining a light onto practices that existed, in decades past that, are downright illegal now. I mean, the quote from Wolf of Wall Street where McConaughey is talking to Leo, and he says something along the lines of, the name of the game is taking money from your client's pocket and putting it into your pocket. And that's the way a lot of Wall Street has been built, in the sort of transactional brokerage business. And even today, I mean, you can find a S&P 500 mutual fund that exists that charges over 2%. And they're not even pretending to be doing anything. They're just literally buying the S&P 500 index, which you can get for, I think, 2 basis points or something now. I think hopefully a lot of the there's possibility that people are, the industry is moving forward in a positive way. Sometimes I get a little despondent and think that, it's a hopeless task because we don't arm most of our citizenry with a reasonable education in personal finance or investing. And so going back to the beginning of the base of the pyramid, people ask me about investing. I say, look, let's talk about something else first. I mean, what you invest in is swamped, absolutely swamped by your decision on how much you save and when you start investing. So you start saving a fair amount of money, you start investing early, the best time was 20 years ago, the next best time is today. That's vastly more important than whether you get a 10 or 11% return.
Right.
And so I think for most people, just that's the hard part too, though. Everyone loves spending money. They saving it is having some empathy with your future self, and it's hard. It's hard for people to learn that lesson, which is one of the things I'm pretty positive on the whole FIRE movement. I love to see that the focus away from consumption and more on savings. But at the same time, it's frustrating too.
Mm-hmm. Yeah, and I noticed in there too that you also said that your investment pyramid is also very personalized, just like the food pyramid. It's something that you really have to personalize for yourself if you want this to work for you. Not everything's going to work for multiple people.
Yeah. I mean, and that's the thing is like my mom. I love talking about her as an example. She's like a buy and hold stocks person. And then she puts a big chunk in CDs and she's happy. She sleeps at night. Other people, I'm a automated sort of person where I want it all in automation. I don't want to have to think about it. I want, the retirement accounts to get contributed and I want it all to whir in the background. Someone else could say, you know what, Meb, I invest a quarter in gold and a third in real estate and 20% in stock, and that's fine. The problem is that people run into is thinking they have a plan. And listeners, you can be honest about this, and I already know the answer, but we consistently ask people, do you have a written investing plan? And no one ever does. I mean, no one. And so it doesn't have to be complicated. You could write it down in 4 or 5 bullet points, but the whole point is not having one causes emotions to creep in. And when emotions creep in, everything sort of fractures. And so a good example, again, would be, weight loss and exercise. If you have a plan and your spouse or partner or parent or child or neighbor is keeping you honest, it's a lot harder to deviate than if you don't have a plan because you wake up and you're hungry and you go get a scoop of ice cream or a sandwich in the middle of the night, So same thing with investing is you don't have a plan and you get sucked into geopolitical news of the negativity, and almost always it ends up being something that works adversely against you.
Right. So then now I have to ask, and this is my favorite question, what investing experience would you say has shaped your current investing thesis?
All of them, there's let me give you a good example, and I'm very transparent about what I invest in and how I invest. You can find some old articles on the blog that detail very specifically what I do with my own money. Money is a very taboo subject, which is a little odd. Talking to people, if you were to go up to someone tonight at dinner or happy hour and say, "Oh, how much money do you have?" Or how exactly do you invest your money? They would be very taken aback and think you're probably a jerk. but really, money shouldn't be that taboo of a subject. And so, I invest in a way that I'm pretty sure no one else in the world does, where, with the caveat being that probably most of my net worth is invested in my own company. And, as far as the public investments, I put almost all of it into just one fund. And again, no one else would do that because that's crazy to them. They don't feel diversified, but that fund owns a number of other funds. And between those, they own probably 20,000 plus securities around the world. So that works for me, and it's easy. I just see one line item on my statement. And the real thesis is that, we've talked a little bit about buy and hold investing, and I think buy and hold is a totally reasonable way to invest. I think the problem is buy and hold for most investors is that when it hits bad times, those bad times are correlated with bad times also in the economy and in people's personal lives. So think back to 08, 09, your portfolio goes down 20, 30, 50%, but also you're in a recession. People are losing their jobs, unemployment is spiking, and the geopolitical news is terrible. So it all happens at once, and that's traditionally the problem with buy and hold. And you don't do anything. All you do is rebalance, and so you feel somewhat helpless. And on the flip side, we mentioned trend following, which has its own challenges, which are largely you look different, you may underperform when everything else is doing great. Traditionally the long bear markets are not a problem because it usually will exit or go short depending on your strategy. And so I've kind of cobbled together, for me personally, we've published papers on this called the Trinity portfolio, where I say I want to put half in each. And that way it's sort of a yin yang where I don't ever feel too exposed to one strategy or the other. And this last year is a great example. Q4 last year, most markets, it was hitting the fan. They had terrible performance in the end of 2018. And so I'm glad I have some trend following exposure because that's reduced my exposure to what these markets are doing. And I'm glad I don't have all my money in buy and hold. Well, look what happened in 2019. The exact mirror image opposite of 2018. Q1, I said, man, I'm glad I have some buy and hold because otherwise I'd have no returns. So, but that's what works for me, and so I think it's important for people to really find out what a reasonable approach is for them, and the biggest advice you can give there is to look back in history and try to understand how these sort of things would behave, because I think expectations are a big problem. Most of the studies right now say that people expect over a 10% return for their investing portfolios, where in the U.S. we live in a world where U.S. stocks we think are going to be due about 3% and U.S. bonds about 2% going forward. That's a far cry from 10. Mm-hmm. You can't add those two together. You can't multiply them together and get 10. So it's, the expectations versus reality, I think, is a big problem. So anyway, I think they all shape it. And mm-hmm. the challenge, I think, is as you go forward, an investor, is to not let them just be like scars that you continually chase what's hot. And that's probably the biggest mistake people make, is they just chase whatever is looks good today. And usually that's a pretty, and that's, by the way, this isn't me talking down to individuals. Professionals do this as well. Tons of academic studies show that they're equally as bad at chasing the hot hand. And historically, it's been a big headwind to success.
So, Meb, for those who may not, or that let's say they're in their young 20s, because there's a lot of people in my business school classes where, we talk about in our finance class where, we talk about the Buffett record, Munger record, and buy and hold, and the buy and hold strategy. So what would you say to those people that, may be aware that these strategies work, but just are still working through the discipline of trying to get there?
I think the first advice is just get involved, start to put some money to work. And I think I love the automated platforms like Betterment. We offer one, but I think it's a wonderful user interface for young people. You could certainly just open up a Vanguard brokerage account and start allocating to things. If you're very serious about long-term compounding or just making investments that you can forget about, the best advice you give to people is you buy something and you just never sell it. Buy a target date fund, and one of the hacks, it's not really a hack, but I think it's a useful framework, is if you tell people to frame it not as investing, because that gives it some, like, in my opinion, it gives it a little bit of like a gambling, speculative feeling towards it. But you just frame it as savings. Say, I'm going to save and put my money into these Vanguard ETFs. Hopefully they're Cambria ETFs, but maybe they're Vanguard ones or target date funds, whatever it may be. Just start to put it to work. And I think as you look at these tables that demonstrate investment returns and how they compound over 5, 10, 20, 40, 60 years, I mean, if you put it into one of these funds, and the younger people on here that do have 50 years, it has the opportunity to 100x, not 100% returns, 100x, meaning 10,000 is $1 million. So you sock away $10,000, a young 20-something, and everyone's going to live to 140 for that demo. But 20-something, by the time you're at 60 or 70 maybe, you're going to have $1 million. And that's, not guaranteed, of course, but that's awesome. Mm-hmm. But the problem is you don't start until you're 30 or 40 because you went to Cancun or, had that sports car. I think it's time is by far everyone's biggest positive that they can add to the repertoire.
Mm-hmm. And Meb, before I let you go, you have this podcast, the Meb Faber Podcast. Why'd you start that and put that out there?
You don't have to let me go. We can stay here all day.
I'd love to, man. Let's keep going.
So, so we've been putting out content for, it seems like forever. I mean, it started with the white paper you mentioned. Mm-hmm. And we started writing a blog, which has like 2,000 posts. We don't blog as much anymore. I don't know, a dozen white papers, 5 books. And I'm not there to pretend to tell people how to consume content. I mean, look, I'm an old school physical book guy. It's like 90% of my audience reads ebooks, which I think is crazy. But I'm not here to tell people what to do. So, we were one of the early podcasts, not the original first round, but kind of the second round, and certainly before it's been this amazing, explosion of content. It's wonderful. I subscribed, I think, over 50 at this point. It's a problem. But, I said, look, we had been wanting to do a instructional video series. Mm-hmm. The problem with videos, I mean, I think one of the biggest opportunities out there, I wish someone would do it, would be to do a sort of Rosetta Stone for investing instructional coursework so people could start to learn about investing in one place. I don't want to do it because it's too much work, but listeners, feel free to take the idea. I said do a video coursework. But I said, you know what? So people are these new podcasts, maybe people like that. And I did a poll, and it was like 90% wanted podcasts. And that kind of set off a light bulb in my head. And, back then it just seemed like so much work. But once you got the equipment and set up, it's really not that bad. And then just started recording them. And it's been so much fun. I love chatting with people, and gives you an excuse to just ring someone and say, you want to chat on the phone, on the Skype, on the mic, local, and it's you learn a lot of stuff. I mean, there's been plenty of podcasts where you just sit back and soak it in. So it's been a lot of fun. People consume them, walking the dog, going to the gym, commuting, mm-hmm. And you can kind of. I actually just invested in a podcast company or a fund. It's almost like a new asset class that invests in young startup podcasts. And I don't do it, they do it, but that's what a cool idea. But I'm very bullish on the podcasting space. It's little known, but it's like 5 times the revenue in China because they monetize it in a different way. But I think it's in the early days, and it's got a lot of legs.
For sure. Well, dude, with that, Meb, where can my audience go and find more information about you, Cambria Investment Management, and your podcast?
All right, so you can watch me pick fights on Twitter at Meb Faber. You can see the blog and podcast at it's just mebfaber.com. And then my day job, which is managing all the Cambria funds and investment accounts, is both cambriafunds.com and cambriainvestments.com.
Meb, it's been an absolute pleasure, man. Thank you so much for joining with me today.
Let's do it again sometime.
Absolutely. All right, I'll talk to you soon. Thank you all for tuning into the Planet MicroCap Podcast, and thank you, Meb, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast. Go to podbean.com and search Planet MicroCap Podcast, and also you can search on iTunes, Stitcher, and Spotify, Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@snnwire.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the Microcap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.